Welcome, Easy Equities investors. I'm really excited to be joined by John Cherry from Investec. John's also a client of Easy Equities. We're big fans of the Investec structured products, and John's kindly agreed to chat to me for a few minutes about one of their latest offerings. So welcome, John, and thanks for your time.
Thanks, Carl. Happy to be here.
Maybe we can kick off by just a quick reminder to our investors on what a structured product is, and maybe just give us a summary, please.
Sure. So in a traditional space with investing, you have three options to buy. It's basically cash, bonds, and equities. And equities in the long run have typically produced the best returns, but it comes with the risk in the short term that the market falls and you lose money. So structured products are designed to capture the best of both worlds, where it's linked to equity markets. And later we'll talk about the S&P 500. But if the market goes up, the client gets a return linked to that performance. But should the market fall, there's an element of capital protection that helps the client avoid those downside risks inherent in the equity asset class.
It's great. I love it when clever people can explain something succinctly. I couldn't say the word, so it's great. And, for me, it's just clever people at Investec working out a product that gives us some really good exposure. So maybe let's talk about the S&P 500 Digital Plus. So what is that product?
Sure. So it's a 3.5-year investment. The clients invest with rands. It's a JSE listed product, hence why we're making it available on Easy Equities. And after 3.5 years, we tell the client a payoff that's basically promised from us. So the payoff is linked to the performance of the S&P 500. That S&P 500 is an index which basically has the largest 500 stocks in America. So think about your Apple and your Tesla and your Microsofts. And the product after 3.5 years, what we do is we look at the index on trade date and we look at the index at the end. And they're basically 4 scenarios that the client will get. And as I mentioned earlier, the product is based on the performance of the index. What we try to do is give the client a better performance on the up, as well as a better performance on the down, providing that protection.
That's fantastic. I mean, it's also great that you can use your rands to get, this exposure offshore, as it were, in a very easy way.
Yeah. So very simple to invest, especially on Easy Equities. You just click apply with the amounts you so choose, and then a minimums on the platform for Easy Equities clients. And just to give you an idea, so after 3.5 years, if the index is flat or positive, so if it's up 0%, 1%, 5%, the client gets a 40% return in rands. Secondly, if the market rallies, we obviously would love the markets to do 60, 70%. If that is the case, the client isn't capped at the 40. If the market is more than 40%, they get the full upside benefit. So if it ends 60% up, the client will get 60% back at the end, plus the initial capital. And this is all after fees, costs, and expenses, which are built into the product. On the downside, if the market ends down, but less than 30% down, the client gets the capital back. So as an example, if the market starts off going down and ends sort of 20% down at maturity, the client put in 1,000 rand, they get back 1,000 rand at the end. And that's quite important for us as a product creator. Our goal is to return the client's money at the end if markets are down, and give them a good upside if markets go up. Where the risk is to the client is if the market ends more than 30% down, the protection falls away and they get the same return as the market. So if the market ends 40% down, the client will lose 40% of the investment value. While this is a risk, historically, if we launch the same product every day since 1987, this risk, this sort of historic propensity is just over 2%. And if you look at the times when the client would have lost historically, the 2 different times that happened was if investors had done this just before the dot-com crash in the early 2000s and just before the global financial crisis in 2008. So there always is a risk in the product that the markets do fall more than 30. However, the hope is that the product will perform well when markets are flat or up, give you unlimited upside if it rallies, and protect you to a large degree on the downturn. So a small amount of downside risk in return for better returns in a moderate down case, in a moderate up case, and a bull case.
Yeah, it's fantastic. I mean, I love also the disclosures in the presentation that you guys have got on the platform, because you share that back testing that you've done. You're very clear on the risk, and the product, in many ways, it sounds nearly too good to be true. because there's no limit on this upside.
Yeah, and look, we do get that a lot, especially for first-time clients who haven't been exposed to structured products or other alternative asset classes. What I can say is we've done 180 products in the last 20 years. About 100 have matured, and not one has lost a client a cent if they held to the end. So 4% return capital, and in those cases, the markets had fallen, clients got their money back. The balance returned profits to the investor, and not one returned a loss. So that's something we're very proud of, something we don't want to change. That's why we're very careful when we pick our levels and our protection levels in the product. And one thing to add is, although it is a fixed term product for 3.5 years, we do provide liquidity on the product. So let's say after 2 years, the client needs the money for whatever reason, they just contact Easy Equities, who contact us. The price is daily priced in the market, and they can sell it back to us at any point.
Yeah, which is also fantastic to provide that liquidity. Well, thanks very much, John, and thank you very much to Investec for having this product on Easy Equities and for not having minimums, because generally retail investors wouldn't be able to access these products because of minimums, and often these minimums are very high. So it really is fantastic that you make it available to us. You've got a couple more that are coming later in the year, so we'll share more information on those. Some are not rand based, some are US and other denominations, so it also gives some lack of diversification from that perspective.
100%. Thanks for having me on the show, and we'll be in contact soon.
Keep well. Cheers.